Hello, everyone. Today on the final bar, my guest is Al Brooks from the Brooks Trading Course. Going to talk to us about a little long-term view of the S&P, but a perfect time to be going through his perspective because we're selling off pretty well today going into the close. So how does that fit into the big picture? You know, S&P rolling over is really the defensives that led for most of the day. Also, technology at the very bottom. So you're getting some weakness from places like the NDX that have been positions of strength. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for the show to review the action of the day, try to connect what we see today with the longer term trends, how they've evolved, how they're changing, try to focus in on some inflection points, but most importantly, get a proper long-term perspective to what we're seeing. And thank you everyone very much for being patient with us the last couple of days and for well-wishing emails that I received. Long story short, we completely lost internet at my house, which is where I'm running my portion of the show. So I had to scrap it, trying to get things back up and running. And finally, we were able to do it yesterday evening. There's a much longer and exciting story, but rest assured, the Keller family is back online. The children in the Keller family are probably most excited about that, but I was also very excited to get back to quote unquote normal, as much as normal has been recently, and get back to the charts in detail. But I have been checking on emails that I've received from many of you. We have a mailbag segment today where I'll answer some of the questions we received earlier in the week, and we've gotten so many. We'll do another one tomorrow as well to get through many of the questions that we've received. But I think it's all about leadership rotation right now. And again, we're getting rotation away from tech, away from consumer, away from communication services into some of the defensive areas of the market. So we're going to get into all those themes and more today. I did want to hit on some of the guests we have coming up. Al Brooks is joining us today. I met Al at the Money Show in Orlando earlier this year. We had a really good conversation. I invited him to come back on our show today to share his perspective on what he's seeing. And again, one of the great benefits of StockCharts TV, I hope for all of you, is besides having people like me and other hosts kind of talking through our process regularly, getting people like Al and others that I'll highlight here in a moment, getting their perspectives on what they're seeing using each of their unique toolkits. I think it's a really powerful way to enhance your own perspective on the markets. So next week on StockCharts TV, on Monday, we have Behind the Charts. That's featuring a conversation I had with Steve Sutmeyer. I've known Steve for many years. When I was on the institutional buy side, I had Steve's research. We'd meet about once a quarter when he came through the Boston area. He's the chief technical analyst focused on the equity markets at B of A Securities, formerly Merrill Lynch. On Tuesday, we have Keith Fitzgerald from keithfitzgerald.com. He's a fellow Seattleite joining us remotely, though. On Wednesday, Louis Yanis from Wellfest. And then Thursday, Larry Berman. I followed Larry's work and have worked with him on the CMT Association. We served on the board there of the MTA for a number of years. Larry's going to join the show next Thursday. So we have some great perspectives coming up. Going on to our market recap here, when I'm looking at this, my conversation with Ralph Akinpour a couple weeks ago, this was part of the Charting the Second Half special week that we had all last week on StockCharts TV. And if you missed some of those presentations, go to our YouTube channel and go through some of especially the keynote messages, which I thought were fantastic. Martin Pring, Linda Raschke, Chris Chavacco. We had so many great people giving their perspectives. But I had an interview with Ralph Akinpour, and that was what he wanted to do for his special. And we ended up talking a lot about leadership rotation. And since that conversation, I feel like that has happened more and more. And today is a perfect example of that. It's more of a risk-off trade away from the mega cap tech, communication services, consumer discretionary, into the more defensive plays like consumer staples, utilities, financials. These are the things that have been struggling on a relative basis as the FANG trade has dominated. Today certainly felt like the opposite, a bit of rotation away. I'll show you what happened. I'll show you some of the charts that hopefully will put that into proper perspective, and we'll see what else we can get to before the break here. But the S&P finished down about 1.25%. That's down to 32.35. Really sold off into the afternoon, then chopped around. Mid caps and small caps actually finished in the positive. Small caps actually led the way higher. You can see it sold off into that same time, but then rallied into the close while the S&P sort of remained muted. The NASDAQ 100 was really the big loser today on a relative basis, down 2.2%. The VIX is back higher, above 26 again. Looking at non-equity markets, bonds were strong pretty much through the course of the day. 10-year yields back, now down below 60 basis points. On the commodity side, gold really accelerated out of the open, but peppered off a little bit. Still finishing up about 0.9% from yesterday. Oil weaker, and energy was just below flat for the day, the energy sector. But, you know, when we talk about stocks selling off, you talk about weakness in the S&P, you talk about this potential leadership rotation. Let's remember, take a step back here and look at a daily chart of the S&P 500. This sell-off pushed us exactly to where we were on Monday's open. So we didn't really, you know, it's not like we completely killed this uptrend. This is a bit of a risk-off, you know, a normal risk-off move within an uptrend. So, you know, if you're long-term bullish, I don't think this should scare you out of anything. Should certainly, you know, help you think about where, you know, what sort of downside risk you'd be happy with, what sort of levels you'd think about revisiting some key holdings or some key names in your portfolio. But overall, the trend still remains overwhelmingly positive. So we're still, you know, within 200 points of the all-time high there from February, around 3,400. You know, still above all long-term measures of trend and the overwhelming positive or the overwhelming scheme, I think, of the market remains on the positive side. This is a pullback within that uptrend. At some point, it turns into something different. And again, for me, based on what we've done, seeing the bull flag that resolved higher, seeing the pennant pattern or the symmetrical triangle, this coil that resolved to the upside, breaking above the previous highs, the first thing you would look at, I mean, the very first thing would be resistance becomes support. So this level around 32.30, this was the line in the sand, the peak from June that we retested a number of times over the last couple of weeks. When we finally broke above that, that was going, you know, coming into this week, for me, cleared the way to 3,400, and I think that's where we're going to end up getting to. But what would tell me I'm wrong, first thing first, do you hold that support, that resistance level that we broke out of? Do we hold that? And I think today we really closed right about at that level. So the question is, do we hold it? As long as we remain above that, the uptrend is certainly in good shape. If we would break below that, I would immediately look down to those previous swing lows. You always look back to the previous low because an uptrend is higher highs and higher lows. A downtrend is lower lows and lower highs. So you'd want to see it hold above that previous swing low, which is from the beginning of July. That's around, you know, 31.20 or so. I would say maybe that's from that low from first week and a half of July. So I'd be looking at those lows there, that support range, that demand area really where buyers sort of stabilized before. If we get back down to that range, I'd expect that to hold. And if we break down through that, then you really have to evaluate some further downside. What's interesting, though, again, putting this into perspective and not to get too deeply into the mailbag, but one of the questions we're going to talk about is with divergences. And I would say I've been hesitant to call this a bearish divergence with higher highs in price, lower peaks in the RSI, but today starts to potentially give this a sign, you know, sort of confirming this as the most recent peak. I think tomorrow is where you'd sort of validate that or not, in which case you arguably have a bit of a bearish divergence on the S&P 500. But I think it's a little too early to proclaim that being all said and done here. But that would be the next thing I would be looking for. Let's get back to the recap and see what other themes we can tease out of. So again, this is definitely a move more, you know, risk off going into staples. We talk about some of the charts in staples, and I haven't looked at these yet today. That's not the right symbol, KHC, Kraft Heinz. I was just trying to think of some of the staples names that we've reviewed recently, maybe from Friday's or from Monday's segment, you know, looking at bottom up stock picking and how they've fared. Kraft Heinz now has remained, you know, holding up. So while the stock sort of sold off today, Kraft Heinz was sort of flat for the day. Relative strength teasing now a new 52-week high, which would be pretty compelling, and a decent dividend yield. What's interesting in some of those defensive areas, the dividends look a lot more attractive than what you're probably used to looking at a lot of the FANG stocks. I think what's more concerning than, or more important than things like Kraft Heinz holding up, I think it's looking at some of these names that have been bellwethers. Sorry, I've got like fat finger typing here. Some of the bellwethers starting to show some questionable patterns. So Tesla, this is one that's been rallying beautifully and has gone exponentially higher. The percent moves on this stock have been exceptional. Just earnings this week and after hours yesterday, if I remember right, was up pretty decently, but actually closed down 5% today. This pushes it out of the overbought region for the first time in the month of July. Last time it was not overbought was back here in late June. So an interesting rollover. But again, overall the uptrend could certainly continue higher. This is one day, but I have a bearish engulfing pattern. It's coming out of the overbought region, which suggests to me in the short term, I'd expect weaker rather than stronger, just based on that short-term trajectory. Let's check in on some of the other mega cap techs, and we have to roll over. Or we have to move on. Sorry, I brought up the chart and roll over just came out of my mouth. That was a good Freudian slip there. But, charts like Apple, this is what concerns me a little bit. So, Apple now certainly looks like a very confirmed bearish divergence of a pattern of higher highs in price over the last 6 weeks, a pattern of lower peaks in the RSI or that same period. The relative strength now rolling over the RSI back around 50, and it's broken now below its swing low. So I would be checking in on some of these larger names and see how they pull back today, especially mega cap tech. I think that's where you're going to see the most concerning divergences that have now started to follow through a little bit to the downside. That's all the time we have for our recap today. Again, a lot of themes to tease around. In our mailbag, we're going to get to some of these in a little more detail. We need to take a quick commercial break. We'll be back with my guest, Al Brooks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday for the show. As a reminder, you can get any questions to us two ways. One is via email, thefinalbar@StockCharts.com, or on Twitter, just tag us in a comment at FinalBarSCTV. We've gotten so many great questions, feedback, and ideas from many of you. Keep the questions coming. We're going to do a mailbag segment a little later in today's show. We'll also most likely do one tomorrow to get through all the great questions we've received from you recently. So keep them coming. We'd love to hear from you. And nothing is out of bounds. We'll do our best to answer everything we can. As I mentioned, we have some fantastic guests coming on the Final Bar, and today is certainly no different. Al Brooks is joining us from the Brooks Trading Course, joining us from Northern California. Al, it was such a pleasure to meet you in Orlando earlier this year. And while it would be great to meet in person, I'm happy to have you on the show virtually, given everything going on. So welcome to the show.
Thank you very much, Dave. I really appreciate the opportunity to be speaking to your group.
Of course. So you sent a couple charts ahead of time and pretty long-term charts. The first one is a monthly read on the S&P 500. And I'm curious, obviously, a bit of a risk-off move today. I'd love to know what the charts are telling you about the long-term trend and what you're keeping in mind right about now.
Well, it's interesting. I made these charts yesterday. I sent them to you yesterday, and it's pretty timely. Inside that light brown box, there are 3 bars. That is April, May, and June. And a couple things I want to say about that. April, a big body. And then May, a medium body. And then June, a small body. So the bodies are shrinking, and that represents a loss of momentum as we're going up. And then also at the top of June, there's a big tail. And that represents profit taking. Whenever you're in a rally and you get a big tail on the top of the bar, that means the bulls are not buying into the close of the bar. They're taking profits. And late in June, when June was looking that way, I told my group that it reduced the chances of July going much above the June high, because you have shrinking bodies and you have a big tail on the top of the bar, and you're at resistance. You're testing the old high. And because I said that July probably would have a hard time going much above the high of the bar, and now July is above the high of June, there's an increased risk of a reversal down at the end of July. And that's what I have been saying. There's no sign of it when you look at this chart right now, but that's just something to keep in mind. We have shrinking bodies and we have a big tail. July probably is not going to be able to go much above the June high, and therefore it might be a second consecutive bar with a big tail on top. I want to say one other thing about this chart. The green bull trend line, the market broke below it in March and reversed up strongly. And I've been doing this now for more than 30 years. And the 1987 crash, if you look at it, it reversed up from just below a monthly bull trend line. And then we had a big sell-off in 2002, 2003. That reversed up from right below a monthly bull trend line. And then the big sell-off in 2009, that reversed up from below a monthly bull trend line. So that's just something to keep in mind if you're an investor and you see the market breaking below a monthly bull trend line that goes back 5, 10, or 20 years. That's a good time to be thinking about going long. That's a good time to be investing. Dave, would you go to the next chart?
You got it.
This is a weekly chart of the E-mini, and Dave shows the cash index, but I'm a trader and I can't trade the cash index, so I have to trade some kind of a derivative, and most often I'm trading the E-mini contract. Whenever there's a big sell climax, we have two here. We have one back in December, and then we have another one back December 2018. We had a sell climax, and then we had one here in March. Whenever there's a sell climax and a reversal, I'm always thinking about a cup and handle pattern, which is a type of reversal pattern. And back, if you look back at the green one, we had a reversal up from a sell climax and then a pullback. And whenever you get a pullback from a reversal up from a sell climax, it's a cup and handle pattern. And that handle is a bull flag. And it's more likely that the market is going to continue up at least a little bit after that pullback. Now, we had a sell climax in March, and we're currently in the process of having a big reversal up. At some point, we're going to get a reversal attempt down. And with the trend as strongly up as it has been, it's very likely that whatever sell-off we get from here will form a higher low and we'll get one more attempt up. So I expect that we'll pull back. I don't know how long we'll pull back, but maybe a month or two. And how deep do we go? Dave was talking about that congestion back in May and June, right in there. And whenever the market is sideways like that, I think traders are telling you that the market thinks that's a fair price. We're now above the fair price. So if we reverse down here, it probably is going to get back to that fair price. And typically, it'll get to the bottom of that trading range. So as a minimum target, I think we're going back to the bottom of that trading range. So that is probably going to be the final bull flag. We don't know where the top is, but you can see I have a horizontal pink box, magenta box that goes back to the February gap. That gap, it's an unusually big gap. It was the start of the crash. And for the past couple of months, I said that, yes, I expect a reversal down, maybe to the middle of the 3-year trading range, but the reversal probably would not begin until after we get above that February 24th high into the gap. And that's where we are this week. And today dipped back down below that February 24th high. And the market's deciding, are we going to close the gap? Are we going to get to the top of that green box, that pink box, or are we going to stall here and then reverse down? I think there's a 50-50 chance that we stall and we go up to a new all-time high, and a 50-50 chance that we stall and reverse down. And if we start to get follow-through selling over the next few days, the probability of the reversal down will go up. It might go up to 60% if we start to get additional bear days. For example, if we get 2 big bear days. And I've been thinking about the last week of July as the start of the reversal down. It's possible that it's starting today. At a minimum, whenever I'm looking for some kind of a reversal, a cup and handle type pattern, I'm looking for the market to retrace about 1/3 of the rally. And that would be back there at those, at the May-June low. So yeah, down in there. So that would be the minimum objective for that handle. I have the handle drawn in, not very deep at all, but really, realistically, I think it's going to be at least down to the May-June triangle. And one other thought, the market has been in a trading range for 3 years, and we're near the top of the range. When the market's in a trading range, reversals are more common than breakouts. So the traders who are looking for a big breakout above the February high, I think we might get above the February high. I do not think we're going to get far above the February high, at least not without first pulling back fairly deeply. And what would be the deepest that I would expect? I would expect possibly down to around 2,700, that other area of congestion that was back there in April, yeah, down there. So that would be, if we do not hold at the June low, that would be the next target.
Oh, this is such a great take. And what I love is the long-term look here. There's, I think a lot of people look briefly at the weekly chart, and I'm taking a bunch of notes just listening to you describe some of the patterns and how to think about it. So thanks for giving us that longer term perspective. Al Brooks, thank you so much for joining the show today. Really appreciate it.
Thank you, David.
That was Al Brooks from the Brooks Trading Course, and again, there's so many things I would love to unpack with him. I'm sure we'll be able to get Al back on the show and dig a little further on that. But it's interesting how when he talks about the cup and handle, how much that potentially would line up with some of the levels we were talking about, that congestion area, taking the pullback after the swing high in June. Let's get on to our next segment, the final bar mailbag. As a reminder, we get so many great questions from you. We're going to answer as many as we can, and we've gotten so many, and because we had to skip the show the last 2 days, we've got some backed up. We're going to get to as many as we can today and tomorrow. Question number one: I noticed on your screen, your dashboard, it's more aligned with what I would like to have, including the sector summary, so I can do the rankings by industry group. Also the scooter report boxes. Yeah, so here's what you're talking about. I think it's on this page here. Let me get that out of the way. So on my dashboard, if you click on your dashboard, this is actually customizable, and I have set mine up in a way that is in line with how I tend to look at things. So I have the market overview here, which you will most likely have as well, and then I have the sector summary in the upper right. Then I have these three additional windows, and I usually have them set up this way with the scooter reports all here, and I'm looking at stocks that are up, stocks that are down, and the top ranked name, just to remember what's been strongest. And then here I have two chart lists that I follow, the ETF list and the industry lists. How do you do something like this? So first off, in the upper right corner, you see these little gears. You want to click on that, and these additional data panels, chart list panels, are the things you want to click on that'll add them to your page. There's also a commentary window, which I'd encourage you to do. I don't have it on because then we'll be running StockCharts TV as we actually broadcast StockCharts TV. That seems like a problem of sorts. So I don't have it on, but I'd encourage you to do it on your own dashboard. But what you want to do is make sure you select additional data panels and chart list panels. What that's going to do is just give you additional windows to use. And in the upper right of each one of those, there's a little more button. You can select what you're doing. You'll see there's a bunch of things on here. I have scooter reports for these three, and then you can select the universe, and these are all tweakable. You can change them on the fly if you want, but that's kind of how I have mine set up. At the bottom, we have two watch lists. So these are two watch lists that I've created called Global Equity ETFs. It has them so I can look in and percent moves, which is up and which is down, and then also the industry groups. If you like either of those, you are welcome to try and create them, or you're welcome to just shoot me an email, thefinalbar@stockcharts.com. I'd be happy to send you the chart list to your login. You can add them and put them on your dashboard as well. Thanks for that question. Question number two, I would like to know if you'd consider the current S&P RSI to be a divergence. Is flat price and lower RSI significant? And what's interesting is you sent this chart about a week ago, so maybe a little bit earlier, and this is before we'd actually broken into new highs. So I do want to address it there, and then I'll tell you how things have changed a little bit. When you sent your question, you were actually saying, you know, the price was sort of there. So it was flat highs and lower RSI. And the way I would answer it there is no, you can't call that a divergence yet, only because we haven't established a new swing high yet. A divergence only, I think, can be declared once you have, you know, the highs and you have the new high, meaning you've you have a peak in the price. It can't be just as the price is going higher, because the price in the RSI, if it would go to the moon, these would both accelerate up and all of a sudden the divergence would be gone. You have to wait until you get enough of a pullback to declare, okay, now we have a higher peak and a lower peak in the RSI. I'm not sure if today is enough to call that. I think some people certainly will. I probably wait for tomorrow to see what sort of follow through we might get. And if we resume the uptrend, the divergence won't look much like a divergence anymore. If we pull back a little more and follow through back into this trading range, this will look more and more like the bearish divergences we've had in a lot of the mega cap tech names. So that's how I'd answer your question. I think you're right for focusing in on that right now. Next question. I know you always use PPO to talk about the momentum of a stock. I don't know how to interpret the PPO histogram. Also, MACD is very similar to PPO. Is that true? And the short answer is yes, you're absolutely right. I'm going to very quickly bring up a chart to show you. Hold on. Market trend model. We go here. I have a list of charts that have this model sort of listed out. Here we go. So this is the weekly model that I tend to use. It's doing the 21 and 34 week exponential moving averages. This is the PPO. So it's basically the difference between these two moving averages, and that's the histogram here. Down here at the bottom, I have sort of the normal weekly PPO. If you have a weekly chart and you add the PPO, it's going to look just like this with the two lines and the histogram. The two lines, when they cross up or down through each other, are the traditional buy and sell signal. So when it crosses up, that's a buy signal. When it crosses down, that's a sell signal. I call that the medium-term trend, just on my shorthand look of using the weekly chart to understand the underlying trend in a security. The histogram here is just showing you the difference between these two. So when the histogram is increasing, that means that the price, the moving averages are narrowing, or they're spreading out if it's above zero. When they when they're turning backwards, that means the moving averages are coming back and closer together. So when they cross the zero line, that's the same place as when the PPO gives a buy signal or a sell signal. So you could just look at the histogram and see when it crosses down through the zero line, that's a sell signal. When it crosses up through the zero line, that's a buy signal. So the change in this kind of gives you the rate of change of the PPO. So if these are accelerating to the upside, that means the trend is increasing. When they start decelerating, when they come down a little bit, that means the trend is decelerating. MACD is identical to PPO, just it's calculated a little bit differently. MACD, the moving average convergence divergence, is based on price levels. The PPO is called the percent price oscillator because it does the same calculation, but it's based on percent movements. The signals are going to be almost identical. It's just the values are going to be different. So PPO allows you to compare different securities, different signals on an apples to apples basis. And that's why I use it. Well, sorry, I wish I could have given more of an answer than that one, but that is the answer on MACD versus PPO and what the histogram represents. If you missed that, if that wasn't clear, go to our chart school pages, search for PPO, and you'll get a well described explanation of what that is. We need to wrap the show, folks, though, and go to the 3 and 3 charts. 3 minutes. Here we go. The first chart comes from my friend Kevin Moore, who's a professor down at Texas A&M. He runs the MSF program. I've known him for many years, and we randomly will compare notes. He sent me this chart, which I thought was really fascinating. If you look at the ratio of the NASDAQ 100 to the S&P 500, just a simple ratio of the value of the NASDAQ 100 to the value of the S&P, we are right back up to the levels we were in March of 2000. That's we just got back to that level, meaning that the NASDAQ 100 is trading just over 3 times the value of the index of the S&P. It's a one observation, but interesting to note the last time that it was that much more than the S&P was back there at the tech bubble bursting. Chart number 2 is looking at the AAII rankings. It's interesting to note, again, a lot of people are sort of hot and cold on how to interpret this indicator. But for me, what caught my eye right now is looking at the extreme bullishness that has happened at previous market tops. We're nowhere near that. Even if you look at January of 2020, we were over 40% bulls. We're still down only at 26%. There's not been this overwhelming support for the recent bull move. And then the last chart is looking at the ratio of small versus large. I kind of declared this a rotation away from small caps here the first week in July. What's interesting is in the last couple of weeks, it's actually rotated back higher. I may have been a little early, I think, in declaring the death of small caps or the end of that uptrend, because you're starting to see small caps outperform. It's a chart to pay attention to for the remainder of the week. Folks, that's our show. Special thanks to Al Brooks from Brooks Trading Course for joining us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.